Hey everyone, welcome back to our channel. If you're new here, don't forget to hit that subscribe button and ring the bell icon so you never miss an update. Today, we're diving into a topic that's becoming increasingly important for anyone involved in the cryptocurrency world: taxation. As cryptocurrencies continue to gain mainstream acceptance and their market value grows, governments around the world are paying closer attention to how these digital assets are taxed. Whether you're a seasoned investor or just getting started, understanding the ever-evolving landscape of crypto taxation is crucial to staying compliant and avoiding hefty fines. In today's video, we'll cover everything you need to know about crypto taxation. We'll explore the history of crypto taxes, break down current global policies, discuss the types of taxes you might encounter, and delve into the challenges and changes in this dynamic field. We'll also look at some real-world case studies and give you tips on how to prepare for tax season. So, grab a cup of coffee, get comfortable, and let's get started with understanding the complex but fascinating world of crypto taxation. To fully understand the current state of crypto taxation, we need to take a look back at its history. Cryptocurrencies, with Bitcoin leading the charge, started gaining traction in the early 2010s. Back then, most governments and tax authorities didn't quite know what to make of these new digital assets. In the early days, cryptocurrencies were often viewed with skepticism and even hostility. Their association with illicit activities on the dark web didn't help their reputation. Consequently, there was little to no regulation and certainly no standardized tax policies in place. However, as the value of Bitcoin and other cryptocurrencies began to soar, authorities started to take notice. The need to regulate and tax these assets became more pressing, especially as more mainstream investors entered the market. By the mid-2010s, some countries began introducing basic guidelines on how cryptocurrencies should be reported for tax purposes. These initial regulations were often vague and varied greatly from one jurisdiction to another. For example, the United States Internal Revenue Service (IRS) first issued guidance on the taxation of cryptocurrencies in 2014, declaring that virtual currencies would be treated as property for tax purposes. This meant that general tax principles applicable to property transactions also applied to transactions using virtual currency. Other countries took different approaches. Some classified cryptocurrencies as currencies, others as financial assets. This lack of uniformity made it challenging for global investors to navigate the tax landscape. As we moved into the 2020s, the rise of DeFi, NFTs, and the broader adoption of cryptocurrencies pushed governments to update and refine their tax policies. We'll dive into these more recent changes in the next section. Let's take a closer look at how different countries are handling crypto taxation today. The landscape is diverse, with each region adopting its own approach based on local laws, market conditions, and regulatory priorities. In the United States, the IRS continues to treat cryptocurrencies as property. This means that every time you sell, trade, or use crypto to buy goods or services, it's considered a taxable event. Capital gains tax applies, and the rate depends on how long you've held the asset. Short-term gains are taxed as ordinary income, while long-term gains benefit from lower rates. Across the Atlantic, the European Union has a more varied approach, as individual member states have their own regulations. Germany, for instance, exempts cryptocurrencies held for over a year from capital gains tax. On the other hand, France treats crypto as movable property and subject to a flat tax rate. In Asia, Japan has one of the more developed regulatory frameworks. Cryptocurrencies are classified as legal property, and individuals are taxed on their capital gains. South Korea, known for its stringent regulations, requires all crypto exchanges to comply with strict reporting standards, ensuring transparency and tax compliance. Other regions like Australia and Canada also have clear guidelines. In Australia, cryptocurrencies are subject to capital gains tax, and businesses using crypto must record transactions in Australian dollars. Canada treats crypto as a commodity, and any profits from trading or selling are considered business income or capital gains, depending on the activity. As we can see, while there is a common trend towards recognizing and taxing cryptocurrencies, the specifics can vary significantly. It's crucial for investors to understand the regulations in their own country and stay updated on any changes. Taxing cryptocurrencies is no easy feat. There are several challenges that both regulators and taxpayers face in this rapidly evolving field. First and foremost is the volatility of cryptocurrencies. Unlike traditional assets, the value of cryptocurrencies can fluctuate wildly within short periods. This makes calculating gains and losses more complex and can lead to significant tax liabilities, even when an investor's overall portfolio hasn't grown. Another major challenge is the difficulty in tracking transactions. Cryptocurrencies are designed to be decentralized and often anonymized, which makes it hard for tax authorities to trace transactions and ensure compliance. While blockchain's transparency can help, the sheer volume and complexity of transactions can be overwhelming. Cross-border transactions add another layer of complexity. Cryptocurrencies facilitate easy international transfers, but different countries have different tax rules. Determining the correct tax treatment for these transactions can be confusing and may lead to double taxation or tax evasion if not handled correctly. Then there's the burgeoning field of decentralized finance, DeFi, and non-fungible tokens, NFTs. DeFi platforms offer various financial services like lending, borrowing, and trading without intermediaries. While NFTs represent unique digital assets, both present unique challenges for taxation due to their innovative nature and the lack of clear regulatory guidance. Lastly, the constant evolution of the crypto space means that tax regulations must continually adapt. This creates uncertainty for investors and tax authorities alike, making long-term planning difficult. Despite these challenges, it's essential to stay informed and compliant. In the next section, we'll look at how some countries are effectively managing crypto taxation and where others are struggling. As we've explored, crypto taxation is a complex and evolving field. Understanding the history and current landscape is crucial for anyone involved in the cryptocurrency market. From different types of taxes to the unique challenges faced by both regulators and taxpayers, it's clear that staying informed is more important than ever. Remember, proper record keeping and staying up to date with your local regulations can save you a lot of headaches come tax season. If you're ever in doubt, seeking professional advice is always a good idea. Thanks for watching. If you found this video helpful, give it a thumbs up and share it with others who might benefit. Don't forget to subscribe and hit the notification bell for more content on crypto, finance, and technology. See you in the next video.